Good morning everyone. I am Samundeeshwari, Assistant Professor, Department of Commerce, Bishop Iber College, Trichy. Today we are going to see about the topic capital budgeting in financial management, and it's one of the most important topic in financial management. So first of all we see what is the meaning for capital budgeting. First we will see what is the meaning for capital and then budgeting. So capital is nothing but the amount which the owner invested in the business for purchasing the fixed assets or for purchasing the raw materials for goods, etc. And budgeting is nothing but the statement of income as well as the expenditure. So then we move on to the meaning for capital budgeting. So capital budgeting refers to the long-term planning. It's not a short-term planning because the capital is required for a long term. So it is called as a long-term planning expenditure for investment in projects. If I am going to invest in a project or I am going to invest in a fixed assets, and what are the method of financing for approving my particular project, all these things will be dealt in this capital budgeting concept. So capital budgeting is also known as investment decision making and expenditure, capital expenditure. What do you mean by capital expenditure? Once I have invested, the benefits will be fetched for a longer period of time, and that is called as capital expenditure. And then next one is planning of capital expenditure. Then next we move on to the methods of capital budgeting. So there are two methods in capital budgeting. One is called as traditional and other one is the non-traditional. Traditional means what? It is the old method. Okay. So in traditional methods there are two things. One is called as payback period method and second one is the accounting rate of return method or annual average rate of return method. So it can be otherwise called as ARR method. The next one is called as the non-traditional method. In non-traditional method it is otherwise called as modern method. There are three methods: net present value method, profitability index method, and third one is the internal rate of return method. So first we see the traditional method, that is old method. Under old method there are two things. One is called as payback period method. So this payback period method is also called as what? Payout period or payoff period. So the period within which the investment in fixed assets or the projects can be required. What is the amount of time which I need to recover my investment? So that is called as payback period method. It ignores the time value of money because money has a time value. Okay, so it ignores the time value of money. So in payback period methods there are two methods when the cash flows are uniform. When the cash flows are uniform, we have the formula for payback period. Payback period is equal to initial investment divided by annual cash inflows. So what is the annual cash inflows when cash flows are uniform? In the sense, in the first year the cash inflow is 5,000 and for the second year 5,000 and continuously it will be 5,000 only. So that is called as annual cash inflows or cash inflows are uniform. The next one is when cash inflows are not uniform. Not uniform means the amount will be differing from the first year, second year and then third year. For first year it is 5,000, for the second year it may be 3,000 and for the third year it may be 2,000, etc. So next method is called as the accounting rate of return method. So what is the accounting rate of return? So it uses the accounting concept. So accounting concept of what? In the sense it is profit, that is income after depreciation, for calculating the accounting rate of return. So this method takes into account the total earnings. What is the earnings which I am expecting from my initial investment over the lifetime. So this method is called as the accounting rate of return method. So similarly for the payback period, this accounting rate of return also have two methods. One is called as the original investment method and second one is the average investment method. For original investment method, the formula will be annual average net earnings divided by original investment minus scrap value into 100, and for the second one, average investment method, ARR is equal to, that is accounting rate of return is equal to annual average net earnings divided by average investment into 100. So if the project which has the highest ARR is accepted, that is the return must be high, then only I can accept it. So we have seen the traditional method. One is called as payback period method and second one is accounting rate of return method. Next we move on to the non-traditional method. Non-traditional method is in the sense modern methods. Under the first one is net present value method. So net present value method depends on the time value of money. As I already said, money has a time value. So it takes into consideration consideration the time value of money. So what is this in the sense? The net cash inflows are to be taken after tax as well as the depreciation. Here for calculating the net present value index, we are going to take into consideration the scrap value as well as the working capital of the project. So this has to be taken for the cash inflow in the last year. So the formula for net present value is equal to present value of cash inflows divided by present value of cash outflows. If net present value is greater than 0, the project will be accepted. If the net present value is less than 0, it will not be accepted. So the next method is profitability index method. So this profitability index method is also known as excess present value index or benefit cost ratio or cost benefit ratio. So it is a refinement of net present value method. So it is most suitable when I am going to undertake 2 or more projects in the same time. I am going to compare those projects with A with project B. So this method is very much suitable in order to calculate my profitability index. So this method is very much helpful in order to find out the relationship between the present value of cash inflows as well as the present value of cash outflows. So there is a formula over there. PI, that is profitability index, is equal to present value of cash inflows divided by present value of cash outflows. If PI is greater than 1, then it is accepted. If PI is less than 1, it will not be accepted. So it is understood that project with higher profitability index will be accepted. The next one is called as the internal rate of return. This is the last method in the modern methods. It is a rate of return at which the present value of cash inflows as well as the outflows must be equal to 1. So it must be equal. The inflows as well as the outflows must be equal. At ARR, the total discounted cash inflows as well as the total discounted cash outflows must be equal. IRR discounts the total cash flows to the level of 0. So it is in the sense IRR is equal to, that is cash inflows divided by cash outflows, which is equal to 1. So these are all the various methods in capital budgeting. So thank you everyone.